Thanks for joining us today for our Cutting Through the Noise quarterly investment update. I'm Tony Welch, Chief Investment Officer at Signature FD. So, today we're going to focus a fair amount on trade policy because that's really been a major market driver here in the past several weeks. Tariffs represent a pretty major headwind due to their potential to lift inflation and or compress profit margins. Moreover, the impact to sentiment has been notable. Consumers and small business sentiment, both of those have been deteriorating of late. Reorientation of global trade could be a sea change event calling into question US exceptionalism. So we'll talk about that a little bit. And at the end of the day, the bottom line is that diversification is really the name of the game. And then core bonds, they've been a reliable hedge in portfolios for the better part of 25 years. But that relationship may be shifting. So we also want to be diversified within our bond allocations. So there's the agenda, and let's just dive right in with trade policy and specifically the tariffs. So, what's the big deal here? Well, this chart from BCA attempts to estimate the blended tariff rate under different scenarios. So, that lower light green dot shows the impact given a 10% additional baseline tariff. The red dot shows the rate if we assume a very high tariff rate on China, even if we reduce our imports from China by 50%. And that top dark green dot, that adds in some key sectoral tariffs on steel, aluminum, autos, and certain auto parts. Note that at greater than 20%, the blended tariff rate would be higher than at any time since 1930. So tariffs are levied on the importing company, which may or may not be able to be passed on the cost to the end consumer. It really just depends on the elasticity of that product. The announced tariffs, even with the pause in reciprocal tariffs, would be equivalent to the biggest corporate tax increase in history. So this is obviously a headwind to either corporate profit margins and or consumer price inflation. So, for context, before the reciprocal tariffs were rolled back, the proposal resulted in more theoretical income than the entire corporate income tax. Strategic Research Partners estimates that the rollback of the reciprocal tariffs amounts to about 80 billion saved, but still there's about as much projected revenue from tariffs as the totality of corporate taxes. A potential positive catalyst could be a further cut of the corporate tax rate paid for by projected tariff revenue. So that's something to watch. Now, as for the impact of tariffs on consumers, this chart shows the percentage of various consumer goods that come from select low cost countries. Note that we get about 70% of furniture and an even greater amount of household appliances from these sources. Other significant categories are apparel, computers and other electronics, auto parts, and finished autos. So here, empirical research is attempting to quantify the impact to inflation from tariff policies by assuming that 80% of the tariffs are passed through to the consumer. Some goods, like appliances, where we get most of the supply internationally, could see a significant change in price. Overall, the far left bar shows that the overall impact to broad inflation would be about 1.5 percentage points. So if inflation would be 3% without tariffs in the next 12 months, it could be more like 4.5% with tariffs. Potentially, the bigger issue is not necessarily the inflationary impact of tariffs, but rather the uncertainty that trade policy has generated. This chart shows the trade policy uncertainty index, and it is absolutely skyrocketed. It's difficult for business owners to plan when they are unsure of the rules of the game. Surveys suggest that corporations have been paring back their investment plans. Now, trade uncertainty has resulted in general economic policy uncertainty. So here we can see that the economic policy uncertainty index is also at its most elevated level since the pandemic. And that's the orange line here in the middle clip. Historically, when economic policy uncertainty is elevated, the economy has struggled to make forward progress. Now, we do, in fact, expect the economy to slow. Now, deteriorating consumer sentiment is also a headwind for economic growth. The black line in the middle clip here shows the Reuters University of Michigan Consumer Sentiment Index. The red line in the bottom clip shows the year to year change in consumer sentiment. Historically, drops like this one have also been consistent with sluggish economic growth. This is an important data point because consumers have been steadfast in their spending since the pandemic, and that's supported the economic expansion. There are some signs that the consumer is beginning to pull back here. Now, consumers are becoming more downtrodden in part because they expect inflation to reaccelerate. So, here in this chart in the top clip, we're showing realized 12-month inflation in blue. And that's actually been improving and it's down to 2.4% over the last year. But the dashed orange line is consumer expectations for inflation in the next 12 months. And that's risen to 6.7%. That's the highest expected inflation rate since 1981. This also puts the Fed in a tricky spot. They've been worried that inflation expectations would become unanchored. So, this data is at least somewhat complicating monetary policy. Now, a major support for consumption has been a strong labor market. The last jobs report was actually quite solid. But we do need to remember that payrolls are more of a coincident or even a lagging indicator of the economy. This chart is showing that the average payroll growth around business cycle peaks, it's showing it in dark green. In light green, it's showing the current cycle. And note that payrolls do not tend to turn down until a few months after a recession starts. Nevertheless, the job market has remained solid. Even though we spent a fair amount of time on tariffs, we should note that our expectation ever since the beginning of the year has been that the economy would slow, and that's even without the elevated trade uncertainty. The reason for that is because real income growth has been slowing. So, this chart here, this is income in excess of inflation, and it's currently running at 1.7%, which is below the historical average of about 3.2%. Real consumer spending tends to track changes in real income. So we would expect less consumer expenditures this year. Trade policy is just another near term headwind. Now, at the end of the day, we need to remain objective and focus on leading indicators. Here we're showing 10 leading indicators of the economy from Ned Davis Research. Only one of those 10 are at a level that's consistent with recession. So, and it's an important one. That's the service sector survey. But other things like state level job creation, housing starts, unemployment claims, and other data points still are consistent with expansion and not yet recession. Now, we would expect profit growth to ease in line with a slowing economy. So, this chart shows nominal economic growth in blue and corporate profits in red. The relationship between the two has softened in recent years, and that's likely owing to globalization, which may be reversing, and strong profit margin growth. Both of these variables actually may be shifting. So the relationship should hold. Slower economic growth does typically mean slower profit growth. Fortunately, the stock market has tended to perform well in most earnings environments. The major exception has been when profits have contracted by 20% or more, and that tends to happen in an economic recession. Stocks have had a negative annualized return when earnings growth is below negative 20% and falling. Now, we're far from that today, but something we'll be watching. Another variable we'll want to keep our eye on is interest rates. We particularly like to follow corporate bond yields as that directly informs the cost of capital for businesses. We can see in the orange line in the bottom clip that corporate bond yields have been rising over the past 6 months, and that has created a headwind for the average stock, which is what we're showing in the top clip in blue. A reversal of corporate bond yields lower could be a tailwind for stocks later in the year. For now, rates are a headwind for stock prices. Now, one of the big picture trends we really need to be in tune with is this so called US exceptionalism. We can see in the top clip here that US assets have steadily climbed as a percent of total global assets. This is especially evident in stocks, where the US is about two-thirds of the global market. Now, it's possible that the reorientation of trade is a sea change event that could call US exceptionalism into question. So, why would that be? Well, it's true that the US runs a massive trade deficit. We can see that in the blue line, which is our current account balance. Perhaps not being discussed enough, however, is the massive financial account surplus that results from our trade deficit. Foreigners are reinvesting dollars back into US assets like stocks and bonds. This has likely helped to feed US exceptionalism by keeping interest rates low and providing demand for US stocks. Now, in the 60s, 70s, and 80s, we ran a very balanced economy. But in that balance period, inflation was higher and stock returns were weaker. So that's something to be cognizant of. So let's unpack US exceptionalism in terms of stock returns a little bit more. The outsized US returns relative to global markets can be mostly attributed to the largest companies in the index. In fact, the top 10 companies trade at a price to earnings ratio of about 34 times earnings. The rest of the 490 stocks trade at 23 times earnings. The top of the market remains pretty expensive, even though these are terrific cash flow generators. So this chart from JP Morgan is truly incredible. In gray, it shows the S&P 500 index if we were to strip out only Nvidia. Take out that single stock and the domestic index has actually underperformed Europe and Japan over the past 2.5 years. Maybe US exceptionalism has already been turning prior to the new trade policies. What's been unique to this cycle is that the top performing US companies are the largest companies in the world. But this chart shows that the share of the top 50 performing companies that come from the US, that's the gray bar, and then then other markets here in purple. And note that the best performers can really come from anywhere around the globe. If the top of the US market falters, it's not difficult to imagine that some global companies could take the baton. It makes sense to us to be geographically diversified. We also need to be thinking about the diversification benefits from bonds. Since 2000, bonds have been a very reliable hedge to protect portfolios from stock market weakness. The light blue bars in the bottom clip of this chart, that shows the correlation between stocks and treasury bond yields. Negative readings mean that stocks and bond yields are moving opposite of each other, and positive readings mean that they're moving together. Remember that when bond yields rise, bond prices fall. So, in the period prior to 2000, when inflation was more of a concern, bonds did not necessarily hedge stock weakness well. If higher levels of inflation are structural in nature, we need to consider that in how we build bond portfolios. So, here we're showing a chart of various bond market sectors and the estimated impact to their prices if yields rose by 1% or if they fell by 1%. Note that longer duration treasuries would see negative returns if yields rose, but many other bond sectors would have a more muted drawdown, or in the case of something like leverage loans, which are floating rate, would see a positive impact from rising rates. So we do not have a strong conviction today in the direction of interest rates. So it makes sense to us to be diversified by bond sector in fixed income portfolios. So let's just recap here. Trade policy uncertainty has shown up in weak consumer and business sentiment. In the near term, we expect tariffs are likely to result in a combination of higher inflation and pressure on corporate profit margins. Leading economic indicators have softened but are not yet consistent with recession. The economic call matters due to the impact on corporate earnings. The reorientation of global trade could call into question US exceptionalism. Portfolios should be diversified across sectors and geographies. High quality fixed income has been a reliable stock market hedge for about 25 years, but the relationship has been shifting. We believe portfolios should be diversified across various bond sectors as well. As always, thank you for tuning in, and we wish you a great quarter ahead.